Hello and welcome to Fidelity Connects. I'm Glen Davidson. This month marks the 10th anniversary of Global Intrinsic Value Class. Spearheaded by Joel Tillinghast in 2015, the fund has steadily earned a reputation for its disciplined approach to global equity investing. As it enters its second decade, how is the investment team's approach evolving to meet the demands of an increasingly complex global market? And what lessons from the past 10 years are shaping the next phase of the fund? I'm pleased today to be joined by portfolio managers Morgen Peck and Sam Chamovitz, alongside institutional portfolio manager Naveed Rahman, to discuss all this and more. Welcome, everybody.
Great to be here.
Great to see you all. If I could start with a quick story, and then I'm going to go to you, Naveed. I recall Joel starting the low-price stock fund in the United States at the end of 1989, December of 1989. I was made more aware of him in early 2000 when I was a wholesaler at Fidelity. I remember reading an article in Smart Money magazine, and it touted him as one of the best of the decade, and it was just an excellent overview of what Joel was all about. And I thought, wouldn't it be amazing if Joel could be part of the Canadian offering for our advisors? And sure enough, in 2002, North Star was introduced, where he ran half of it. And then in 2015, of course, Global Intrinsic Value. So he's been a wonderful addition to the Canadian lineup and for our advisors and for clients as well. Now, Joel has been touted by Peter Lynch as being one of the greatest and most successful stock pickers of all time. People ask us often, what's Joel doing now? He planned a retirement that started around 2022, finished in 2023, and he transferred the overall portfolio management to Morgen and Sam, who'd been working with him for quite a number of years. And it's a great example of seamless succession planning at Fidelity. Why don't we hear from Joel now?
Hi, I'm Joel Tillinghast. I was the longtime portfolio manager for Fidelity Low Price Stock in the US and for Global Intrinsic Value Fund in Canada. Fidelity Global Intrinsic Value is celebrating its 10-year anniversary this month. I am so delighted that the fund has delivered well against the expectations we all had for the portfolio. We could not have succeeded without all our amazing advisor partners in Canada. On behalf of Fidelity and the larger team here, thank you so very much. As some of you know, after 30 plus years managing equity portfolios for clients all around the world, I took a step back from client portfolio management a few years ago. I am still at Fidelity and working as a senior equity advisor. What this means is that I work on equity investment related projects that interest me, mentor new analysts at the firm. Plus, it's great to talk and debate with longtime friends like Will Danoff, Ramona Prasad, and others. I am also excited to be working closely with Lisa Wong on a machine learning AI tool that can help analysts and PMs extract and analyze the many data sources we have at our disposal. Thank you again, and I wish you well in all your investing endeavors.
I hear from so many portfolio managers about how they constantly run into Joel at the office and have a great discussion with him. Now, Morgen and Sam, you've been at Fidelity a long time. You've also worked with Joel for a long time, and I know you've learned a lot. Morgen, why don't we start with you just on a bit of your background?
Sure. Thanks, Glenn. So just for a minute on my background, I joined Fidelity in 2003 as a research associate on the core team, and I was covering a number of small cap consumer staple stocks. I then moved to the small cap team pretty early on in about 2005 as a research analyst. And then about 7 years after that, I was rotating across a number of different sectors and had the opportunity to work very closely with Joel on hundreds of companies. I began to manage funds in 2012. That's also when I started working with Sam as a co-PM on various funds. And in the 2015-2016 timeframe, I became the lead PM on two of our core US small cap funds. 2015 is also when I became a co-PM on low price. And then, as you mentioned, when Joel announced his retirement in 2021, I then moved exclusively to the low price franchise. And it's really been a privilege to work with Joel throughout my career. And I would say his unwavering focus on value is something that I have definitely absorbed as an investor. So back to you, Glenn.
Well, I'll bet you've learned a lot. And Sam, tell us about your background.
Thanks, Glenn. I joined the industry in 2002 at a competitor as an associate here in Boston. But after about 5 years, I left to join Fidelity as we were starting the international small cap research team. So we were building this team to mirror the excellent domestic small cap team that we had already developed. Joel and the low price stock fund were the anchors of that team, and a key reason I wanted to join Fidelity. And subsequently, Joel became the most important mentor in my career and remains an influential investor for me. In 2008, I moved to Japan to help start our office on the ground there. In 2012, as Morgan mentioned, started the journey in portfolio management with some roles as a co-manager with Morgan. And then I took sole responsibility for the International Small Cap Fund in 2014, joined the Flips team, the low price team as a co-manager in 2017, and then full-time with Morgan there in 2021.
Thank you. You spent more time in Japan than you had expected to, and Joel has always been a fan of Japan. You must have had some very fascinating conversations.
Yeah, I mean, his involvement in Japan was a key reason I was interested in going. And I knew I could add some value having feet on the ground and eyes and ears there for Joel. So it was quite a great professional and personal experience.
If I asked the two of you a list of attributes that you learned from Joel as a mentor, we'd probably have to extend this to a 4-hour discussion. So I'll just say this: patience was something that he felt he had and was able to exhibit very well. Is that something, Morgan, maybe I'll go to you, is that something that you have found you've learned from Joel?
Yeah, absolutely. I think a core tenet of what Sam and I bring to the funds as fund managers, and something that Joel has had a lot of impact on us, is that sort of, preparation and patience is how we talk about it. And on the patient side, it's a lot of mental toughness where you just have to, it looks like maybe you're wrong for a short period of time, but if you wait long enough, then usually you're right. And seeing Joel do it over and over and over again was really inspirational for us to do the same as we're in this role.
Wonderful. Morgan, I'll stick with you. Co-management. Does that work where each of you have a sleeve of low price stock fund in the States, Global Intrinsic Value in Canada, or do you work together on all the stock selection within the portfolio?
That's a great question, and one we get often. So just to set the stage, Sam and I have, or I think we're now in year 13 of co-managing various global funds together. And the duration of that experience means that we've co-managed in nearly every imaginable market environment, including what we're seeing today with all the volatility. And we've had a lot of time to figure out exactly what co-management means to us. So to answer your question, the best way to describe how we work together is really an investment committee of two. So that means that we co-own every idea together. There are no sleeves, there are no functions that are siloed. We debate and discuss every name that ends up in the portfolio, and we jointly own every name. All the fund exposures, so thinking about the sector or the geographic tilts, those are also decided together, and we also jointly monitor the risk of the funds. The only area where we do tend to act more independently and lean into the scale of having two people is new idea generation. Sam and I are constantly looking for new ideas that fit the process, and we think that we're able to find many more ideas if we're looking in different parts of the market. But I would say that we come together very early on. The minute one of us finds a new idea, we're pitching it to the other person. And so if you think of how Sam and I interact day to day, we're constantly pitching one another new ideas, having debates and discussions. And we think that together we're making better investment decisions than if we were operating solo. So that's a little insight into how we co-manage as a team.
You're pitching one another. You've also got all the analysts coming at you constantly, and you've got all the company meetings up on the 14th floor at the office that you're in right now, and on and on and on. It must be a lot of information that comes to you. Sam, maybe I'll go to you. Morgan talked about patience. Can you talk about the portfolio in times of stress? I think if we look back to even Q4 of last year, Q1 this year, a lot of chaos in the market, the VIX going all over the place. But that's not what you're concerned about within this portfolio, I imagine. When you think of Q4 and Q1, talk about the portfolio.
Thank you. We are long-term investors. But and we do build a fund, or our process is built for periods of stress, and we hope to take advantage of such market environments that we saw in Q4 and Q1. So I'll briefly talk about the process that we hopefully we follow, which reinforce this message. So first, we are deeply fundamental investors, and we make decisions based on fundamental work alongside our research team. We do this opportunistically and with a long-term horizon as we search for underappreciated investment opportunities. So as a core principle, we're looking for resilient business models which generate cash and have attractive growth potential, but only buying them when the market is underappreciating these attributes. We believe paying bargain prices for these types of companies is the key to future excess returns. This happens when you are buying businesses which are misunderstood or out of favor by the market, and conversely, selling or trimming stocks when the market is fully recognizing their potential. Crowded themes and popular stocks are not what we typically look for in investment ideas. This would very much be aligned with the way Joel ran money for so many years. So we tend to zig when others zag. We do not change our process either based on the environment, but we do pay close attention to the macro factors and geopolitical environments, etc., which are influencing businesses and market sentiment as we are making investment decisions. So again, a key part of our philosophy is the world is uncertain and constantly changing. But this is why we're looking for strong management teams and companies which have adaptable and resilient business models, companies with safe balance sheets and generating cash, because these are the things that make weathering tough times and uncertainty easy. So how did this all manifest in Q4 and Q1? Well, turnover increased, which is expected when volatility increases. Volatility is opportunity for the market to misprice stocks, and our job is to be prepared in advance in order to take advantage of these dislocations from intrinsic value. So we are prepared in advance for these types of environments and then hope to act efficiently and effectively when they arise. So although various actions were unique during those 2 quarters that you mentioned, the underlying strategy remained the same. We were recycling capital out of names that had provided relative outperformance in favor of buying the names which were becoming more attractively priced. So across those 2 quarters, examples of the latter would be stocks perceived as Doge losers or tariff losers in the near term, as these were disproportionately hit. And this is where we were focusing our investment. I would like to highlight, though, we aren't always looking for the most dislocated company in the market, because these are often companies with inferior business models or potentially existential concerns. We're focusing our efforts on businesses which have been on our wish list for some time, but become attractively priced because of the market volatility. And during Q4 and Q1, we were able to buy some real gems during that volatility.
This volatility must bring a lot of excitement to what you do, because you do have your shopping list, if you will. And when you see those dislocations, that makes for a great day in the office, I'm sure. Joel wrote a book, Big Money Thinks Small, and in it he talked about looking for bad management as well. I don't expect there's a ratio for that, but Morgan, is that something that you focus on, and how?
Yes, so we're actually looking for great management, and we are looking to avoid bad management teams, no surprise. And I would say that the way we try to, there's a few different ways we try to suss that out. One is, for all the companies that we own, we spend a lot of time with the management teams. We're doing our best to meet with the CEOs and CFOs of those management teams, to talk to them, ask them questions, understand how they think about not only their business and their competitive advantages, but also capital allocation. So sort of interviewing the management team is a really core part of our process. Another important element, though, in our assessment of management is studying the history of the management teams, because actions can speak louder than words. And so a big part of our process is going back for a given company that we might be interested in and studying the actions of that management team, again, whether it relates to operational execution, whether it was good or bad, capital allocation, whether they executed on what they said they were going to do, whether they added value or detracted value. So there are a whole different bunch of elements that go into our assessment of the quality of management, but it's absolutely one of the core pillars that feeds into that sort of quality pillar of our investment process.
Thank you. Sam, Joel has also talked in the past about looking for companies where the management team owns more than 1%. Is that something true today?
I don't have a hard rule, but when we are analyzing management teams, as Morgan was talking about, we're focused on their strategic acumen, we're focused on their financial acumen, so their ability to understand what drives value. And then to your point, we're focused on their alignment with shareholders. So ownership in the stock is an important way to be aligned with our interests, but so are KPIs. You want to have the right KPIs in place so that management teams, not just at the very highest level, but down into the divisional level, et cetera, are incentivized on things that we believe drive value for the shareholders. So focusing not on sales growth, but on profit growth, having a return on capital component so that you can't just make a bigger business, but a business that's used its capital wisely as well. And when those things all line up, that's where we believe our vested interests for our shareholders are aligned with that management team. And that's the key that we're looking for versus a specific ownership. Although we do tend to have a lot of family businesses and large inside owners as well, but there isn't a specific rule that we follow.
Well, that makes a lot of sense. Morgan, global intrinsic value starts with the word global. So you're able to go anywhere in the world. Can you talk about geographic distribution within the portfolio and what that opportunity means to you, and also capitalization opportunities within the portfolio?
Absolutely. So we really like the flexibility of the mandate because it allows us to cast a wide net for dislocations, as you mentioned, across geographies, sectors, market caps. And I would say with the volatility across the markets year to date, we're really leaning into this flexibility and finding a lot of new ideas, as Sam mentioned earlier. If you look at valuations across the market today, we're still finding a lot of opportunities outside the US, so in Europe and Japan. And that's true even despite some of the strong performance year to date in those markets. And that's because the starting point on valuation it was just so low, and they still strike us as very attractive areas in which to invest. So just to put some numbers out there, the MSCI All World Small Cap Index is trading around 13 times next year's earnings. European and UK small cap stocks are trading around 12 times, and Japanese small cap stocks are under 10 times. So if you look at those numbers and compare them to the US markets are still relatively rich in terms of valuation. So the S&P is back above 20 times, and profitable US small cap companies, again, we only focus on the profitable part of the market. Those stocks are trading around 15 times. So you can see that disparity, and that's driving us to continue to look everywhere, but finding more opportunities outside the US. I would say that areas that we've been spending more time on recently are kind of stable, and some might call boring companies that got left behind during the Q4 rally, but which we think are very durable and can do a great job managing through a volatile macro environment. A great example of this is Performance Food Group. It's a leading food distributor to restaurants and convenience stores, and this name fits our process both on the value and the quality pillars. In terms of quality, they provide a really hard to replicate value to their customer. The business is resilient. They're led by a very strong management team who are, proven allocators of capital in a very positive way. And the combination of being left behind sort of more exciting stocks in Q4 and then getting hit on recessionary fears in Q1, it left the stock in, what we thought was very attractive place in terms of valuation. But we're also finding opportunities in more cyclical parts of the market. And I think looking outside the US, DCC is a great example here. This is an Irish distributor of energy, healthcare, and tech products in Europe. It's a name that we've known for a very long time. And management is executing on simplifying the business. They're selling off the healthcare and tech segments to focus on energy, where they, again, have a strong and hard to replicate distribution network. And they're returning a lot of that cash back to shareholders. Stock's been really weak on macro concerns, and again, it's one we think that it's really underappreciated. So that's a quick recap of the types of names that we're finding today, but it's really across the globe.
Across the globe, But stock by stock, is that fair to say? You're not looking at it as let's look at this sector and then dive into it, or let's look at this geographic region and dive into it. You're looking at all the companies because of the vast team around the world, and it just happens to have a distribution that's relevant today.
Yeah, that's a great point. The way that we build the portfolio is absolutely bottom up, stock by stock. And the geographic and sector and market cap exposures that you see in the fund are really an output of those opportunities. So, the names get in on a bottom up basis and name by name basis.
Does a company have to be out of the portfolio if it hits a certain price or capitalization and so on?
No, there aren't any guardrails like that. It's really, the name has to fit our investment process of value and quality. Yep, that's right.
It was a concept, but it's allowing more versatility today, which is great to hear. Sam, a legacy of the portfolio, starting with low price stock fund and global intrinsic value, is the number of holdings. Could you talk about the number of holdings today and what that means for investors?
We cast a very wide net across geographies, business models, and market capitalizations as we look to build a diverse and unique investment portfolio for the shareholders. Our vast internal resources, including the fundamental research team, the quantitative research team, and our trading teams, allow for amazing breadth of work, providing an ability to meet and understand lots of companies globally, which may not be on most investors' radars. One of the results of this is we get to know off the beaten path companies, many family controlled companies and very illiquid companies, which are highly attractive investments, but fit more as part of a tail within the portfolio than, larger specific positions. This provides an attractive exposure to things most funds can't or won't consider. This basket of unique opportunities has proven to provide an excellent additional source of alpha, risk adjusted, to the fund over the course of time. These businesses tend to be well managed and have underappreciated prospects. We will continue to hunt in this attractive pool for investment ideas. And although not the driver of the decision, but just an interesting outcome, is these opportunities are impossible to replicate in the market through passive investment vehicles. They're just too small or too illiquid. They're not part of benchmarks. They don't do the travel to New York and to London to meet investors. So we're really going out there and finding them. And we think this is a very unique opportunity and a special opportunity for our shareholders.
Thank you. One of the points you mentioned, Sam, was family-controlled businesses. Do you have a quick comment on founder-led businesses? Is that an attraction for the portfolio?
Yeah, again, we don't actively search it out, but it does tend to be overrepresented because of the aspects we had talked about before with alignment and good long-term stewardship of the companies. And so we do have a lot of founder-led businesses, but we're not specifically screening for founder-led businesses.
Thank you. Naveed, I should go to you for the last comment on the Global Intrinsic Value Fund. You speak with advisors, institutional investors all around the world on behalf of Sam and Morgan and what Joel has been doing. Could you tell us where you feel this mandate fits within a portfolio based on all the research that you've been doing?
Sure, Glenn. I think first of all, we're fortunate and privileged to have a blue chip list of clients all around the world. Many that have been with us for decades, other that are newer, but it's a really it's a big responsibility for this large client list that we have. And I think the two words or the two themes that come across from our institutional clients, our advisors, time and time again, are consistency and low correlation. Our clients really appreciate that the strong performance that my colleagues Morgan and Sam and Joel before them delivered, it's there year in and year out. We, by our focus, as you heard from Morgan and Sam, on both reasonably priced companies, but also high quality cash generative businesses, we tend to have a very good batting average at avoiding value traps. So that really helps with the consistency of the performance. The second attribute that our institutional clients really appreciate is the lower correlation of this performance stream that we generate. And I think our clients really appreciate that we've generated those returns without owning the same stocks that clients are seeing in many other portfolios. The Mag 7 US large cap growth, that's been sort of the theme of the market for a decade and a half. So we've generated annualized returns without owning these kinds of companies. So I think from a client perspective, they appreciate the performance, they appreciate the lower correlation, and they really think of us as a core building block in a portfolio that is very complementary to most other active and passive strategies that they have. And, I'm sitting here today, I think the next 10 years, we intend to continue to deliver both the journey and the destination that we've had. And that's our kind of modus operandi, and we are not going to chase, and we'll be very consistent in our investment approach.
Naveed, thanks very much for that. It was great to hear from you. And Sam and Morgan, it's very obvious that you've worked with Joel for a long time. It's obvious why you were chosen to work with Joel for a long time, and it's obvious why you were chosen to be at the helm of Global Intrinsic Value. Thank you all for being with us today. It was very interesting, and I hope our viewers found that as well.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.